We have another great discussion here, and this is on some fundamental ideas that you as a business owner or real estate investor should be considering to reduce your taxes. We also go into some ideas that we are exploring and implementing with our clients to maximize current and future tax savings. We talk about implementing an advanced deduction strategy, depreciation, self-employment tax planning, entity structuring, capital gains planning, charitable deductions, and structuring, which is a really exciting topic that very few know about, and future planning. How can we create structures and perform certain actions that'll create future tax savings? Stay tuned. If you like what you hear, subscribe. And always, if you know anyone who wants to join our team, or if you're interested in, or you know someone interested in our services, email info@markperlbergcpa.com. Thank you very much.
So we are going to talk about how to maximize tax savings in 2023 and how to max tax savings. Sure. How to maximize tax savings in 2023. And, obviously we are all, many of these concepts will apply to 2022 taxes. And even though the year has ended, we may have missed out on opportunities with prospects who have not yet become clients. However, we are there are still ways that we can look at your return strategically, looking back when we do your 2022s. And this is some of the things that we're doing with our clients in 2023. So here's just an overview of the different areas we're going to cover here. We're going to talk about deductions, the simple stuff first, right? We're going to take it easy and just talk about some of the basics with you guys. Then we're going to talk about our depreciation strategy, self-employment tax planning, entity structuring, capital gains planning, charitable deductions, and future tax planning. So when I say future planning is, and this is what separates us from a lot of people, and what I want you guys to think about is not only are we going to try to minimize your taxes this year, but there's more to it than that. There's more than just what you read in the bigger pocket blogs, which are good. You may have heard of cost segregation and all these depreciation strategies. You may be able to get to a $0 tax bracket, but you don't want to just stop there. You want to think about how can you best take advantage of this year of tax savings, and how can you do this and create some action to create fewer taxes in future years. So we'll talk about that as well, some ideas that you can use. All right. So first thing we want to talk about is missed deduction, as I call it. Now, the reason why I call it this is because so many entrepreneurs and real estate investors, when they get started, they never get the opportunity to have a conversation with a tax advisor on what they can deduct. And we often see that if we get a client who maybe was self-preparing their returns year after year, we're often going to see that they didn't know what to deduct, how to deduct it, and how to track it. So some of the things you want to think about here is travel, right? Mileage, or maybe getting bonus depreciation for that vehicle. How do you track your mileage? I think Mileage IQ is great, or you can use a template to track it. And there's, also then there's a travel for your hotels. The same. Maybe you can take a vacation time, find business purposes, create it to a tax deductible business event. Lots of opportunities there when you understand the tax code. Now, depreciation, there's cost segregation and bonus depreciation, which I've spent many hundreds of hours discussing with our clients and on our webinars and YouTube page. And that is a big ticket item. But the bonus depreciation is phasing out in the future years, and now we're going to be down to 80%. And also there is, the home office deduction. I want to get you this out of your head that the home office deduction is risky. I think that it was maybe a risky stance in like the 70s before I was born. So we need to get over this urban legend that it's a risk to take the home office deduction. In fact, there's a form that you fill out, and the IRS guides you on how to enter it to calculate your home office deduction. Now, here's where a lot of people get confused, though. is that you need a place that is solely dedicated for your business activity. So if you work from home at your W-2 job and in that same office space you're doing your rentals or your businesses, then it can't be a home office deduction because another recent development is you cannot deduct unreimbursed expenses from your employer. Insurance costs as well. I cannot tell you how many people forget to deduct the insurance of their properties and their rentals, and also self-employed health care insurance is deductible now if you are a full-time entrepreneur. And then finally, professional fees. We see this so many times where they forget that our services are a tax deductible cost. And sometimes, when we are saving our client hundreds of thousands in taxes, we need to charge a decent penny, and they forget to write off our fees. Luckily, we know what that cost is, and we'll make the adjustment. So we got one chat here on how do we minimize your exposure and take the best advantage of our businesses from an anonymous attendee. Well, I want to, when you say exposure, are you talking about exposure to taxes or liability? We'll talk a little bit about asset protection liabilities and give you some ideas you probably haven't heard from other people in when we get to entity structuring. All right, let's get into the hidden. So here's just a definition here I want you guys to think about on what the IRS defines as business deduction. There's some grayness and some ambiguity here, right? It must be both ordinary and necessary. Okay, gotcha. Well, what's ordinary and necessary? They define it. A necessary expense is one that's helpful and appropriate for your trade or business, but it does not have to be indispensable to be considered necessary. So your costs for an appetizer at your business meeting with your spouse, and we like to put our spouses, our client spouses, in their businesses for this. Obviously, your multi-family portfolio will thrive regardless of whether or not you pack on those extra calories with the pot stickers or the dessert at the end, but you're still writing it off on your tax. So then there's a lot of freedom in areas where you probably don't realize you have lots of tax deductions or opportunities to create these tax deductions because it's just not common that entrepreneurs and CPAs get to sit down and understand the law and how they can best use these opportunities. Now, I would say that, part of this is the challenge with our industry as CPAs is that, most firms are structured and there's a culture of just getting the returns out the door and not enough energy in our industry to collaborate with entrepreneurs and help them really be and collaborate with them so they can find the maximum amount of opportunity. Okay, now let's talk about depreciation. I'm going to start off very basic here, but don't worry. If you guys know what depreciation is, this will not be a waste of time. Depreciation is a deduction for the reduction in value over time for the wear and tear of an asset. Like this vehicle here, you see a pickup truck. At first, it's shiny and new, and then over time, the value diminishes, and you write off the value for the diminishing and loss of value of that asset over time. Now, there are opportunities. Now, some people, here's some of them, and here's some mixed things here. You got your straight line depreciation of your house, your rental properties, or your home office, or your office. A lot of people who are self-preparing forget how to write off their depreciation, and a lot of CPAs who aren't specializing in real estate don't really know how to calculate the proper depreciable basis, or they just forget it because they don't do enough Schedule E to report the rental income. And what a lot of people miss also is that your home office deduction gives you an opportunity to create additional depreciation expense. So if a fifth of your personal residence is your home office, you can depreciate 1/5 of that property to offset your business income. Obviously, we have cost segregation. That is the bread and butter of tax savings. We've done hundreds of these. And what you're going to do here is if you have a building in your business, either it's an office building that you could rent to your S Corp or other entity, or a rental property, we break out your rental property into different components that depreciate faster, and we accelerate and front load that depreciation. We can get bonus depreciation and write 100% off any property that depreciates in 20 years or less. In 2022, that amount is going to be down to 80% in 2023. Now, and then there's also bonus depreciation with a vehicle that's over 6,000 pounds. And so we want to strategize and work with our clients on these are some foundational things here. But we also want to consider the fact that now we're down to 80%, and the following year, 2024, we're only going to get 60% of bonus depreciation. And we'll talk about when we talk about future opportunities here and thinking long term, it's going to get harder and harder to generate losses. As you front load your depreciation, you lose it in future years. Your portfolio gets more and more profitable as you gain experience, inflation kicks in, and you acquire more property. So we have to plan. We have to plan for the future changes in the tax environment. Self-employment taxes. Now, for some of you guys who are doing more than just rental investing, even short-term rentals, you don't have to worry about self-employment tax. But what self-employment tax is what I call the silent killer of entrepreneurs. So when you have ordinary income here, and that could be some examples of ordinary income would be if you have commissions, if you run a restaurant, wholesaling, and flipping. People forget flipping is not capital gains income. Anytime you have that type of income, you are going to pay a hefty share of self-employment tax, and that is going to be roughly 15.3% on your first $160,200. They raised it. It used to be only on your first $140,000 back in 2020. Now, for your first $160,000, 15.3% of that is going to be deducted. Is going to be going to the tax man, and you still have to pay your federal taxes at your marginal rate and your state taxes. This is a very expensive tax. And when you have self-employment income, it is the most expensive income you have. So here's some ways that we can plan for the self-employment tax. One is expense shifting. So if you're going to create deductions, you're going to have bonus depreciation in that vehicle and you have multiple sources of income and some are passive, you want to shift your expenses towards your most expensive sources of income. Your deductions against your flipping income is going to be more valuable than the deductions against your rental properties, because rental properties are passive and do not generate self-employment tax. Or if you have a side hustle, or you are a real estate agent, or you're an insurance agent, or just a general business owner, that self-employment income is the most expensive, and we want to move income out of there. You could also make a spouse a passive partner. Give your spouse 50% of your entity, make it a partnership, and now half of that is passive because your spouse is not materially participating in the business, if that is the case. And then the most common one is with the S corporation. So this is what we're doing with a lot of clients, as always. And these are typically what we would see here in typical foundational tax strategies here. And just to illustrate this, I have this visual here on what you do is, let's say in your normal situation where you have $160,000, in this instance, you'd be paying $24,480 in self-employment tax. In addition, you're paying your state taxes and your federal taxes on this profit here. If you're just a sole proprietor, which is what most of you guys default to when you're starting off. So what do we do here? We create an S corp. Now, when you have an S corp, you pay yourself a salary, and only that salary is subject to that self-employment. Well, we call it payroll taxes now, but you got your Social Security, your Medicare taxes, only attributable to the salary that you pay yourself. Anything that exceeds that salary, you do not pay Social Security and Medicare taxes on. So in this instance, where you have $160,000, we now, instead of paying $24,400 in Social Security and Medicare taxes, we're only paying $76.50 in payroll taxes. So here's just one of the many instances where we're creating tons of savings year after year just by understanding the advantages of the S corp and the impact of self-employment taxes. Now, an S corp takes more time and energy to set up. you want to make sure that you have enough profit to justify this tax election. You need to see enough of a discrepancy between your reasonable comp that you pay yourself and the profits in the LLC. Because this amount right here, and when we say reasonable comp, we have to pay you a salary equal to the fair market value of the work you perform in your business. We have a whole process for doing that. But anything that exceeds that is less where the savings is. But if this number, if your salary is too close to your profit, then you may actually wind up paying more in taxes. And always there's capital gains planning here. So, and this should be tied for any of you guys who are real estate investors and have capital gains events that may occur. This should be really integral here. So now, some of the things you want to think about here, if you're a first time short-term rental investor, and we get many clients like this, if this is your first time doing this, we may be able to get lots of bonus depreciation. You don't have a whole lot of cash flow yet in your short-term rental. We bring you into a $0 tax bracket in 2023. The year has already passed. We can't go back in 2022 to do a lot. But let's say in 2023, even with 80% bonus depreciation, we bring you down to a $0 capital gains, $0 tax bracket. That's fantastic. The taxes that came out of your W-2 for your federal and state taxes are going to come right back in the form of a refund, something to get really excited about. You can reinvest that back into your business. But how can we further take advantage of this and consider your capital gains or potential capital gains event? Well, if you're married filing jointly, roughly your first $80,000 of long-term capital gains is untaxed. So what you can do now is you can liquidate or sell stock and not pay any taxes on it. So let's say you have $65,000 of gain that is potentially in your stock portfolio, and you want more capital to invest. Well, let's say we do a cost seg, we generate a $30,000 tax refund, but you want to go a little bit bigger here. You can sell some stock. You're going to get your principal back. You trigger some capital gains that is offset by your losses from the short-term rentals. You pay no taxes, and now we have more cash to build your portfolio. Or let's say you love your stocks, and you're like, well, I want to diversify. I love my Apple and my Tesla stock. So what do? You still can take advantage of it. Sell it and buy it back up at a higher basis. That tax-free long-term capital gains is eaten up by the $0 tax bracket. You buy it back, and now you're avoiding future capital gains tax when you eventually sell it. And then obviously, if you were selling other stuff, other rentals, we got your 1031s. We still can take advantage of qualified opportunity zones, which is a wonderful opportunity. You can sell your stock to put the gains in qualified opportunity zones to get rental income, and then you can get your principal back, and you can use your principal for whatever you want and still pay no taxes on it. Groucho, don't you love that? Groucho loves, anytime I talk about qualified opportunity zones, Groucho gets so excited. He woke up right now. He's very pumped. So obviously, if you ever have any potential capital gains events or things you invest in your rentals or even your primary residence, there may be some tax planning that we can do. And then another thing we're thinking about here, and this is in particular because of the current tax environment. We have a lot of clients that joined us maybe in 2020, 2019, and we've created massive, massive tax savings. We've gotten lots of cost segregation studies, and it's really helped them thrive. They use the capital that they gain, they use their tax savings to reinvest into other property, and they really built a flourishing rental portfolio. But here's the challenge now. As the next, it's great that we can take these W-2 folks and do this, but a lot of them have quit their W-2 jobs now, and they're not paying they're not used to paying any taxes at all. And now, because we front-loaded that depreciation in the earlier years, we don't have the depreciation on those successful properties in the current year. So we run the risk that we're going to generate tax liabilities from their portfolio because they've been building and accumulating all of these properties over the years. And even though they're still buying, they have maybe 5-10 years by which they're investing and growing their cash flowing portfolios. And As we lose that bonus depreciation and it becomes less and less, it's going to be harder and harder to generate losses, and we may have positive taxable income. So we're getting more resourceful and strategic and creative in how we do this. So there are ways that we can create charitable deductions, such as with development rights. There's a way by which you can sell, you can pretty much, instead of selling your property, there are ways by which you can partner with groups by which they will purchase property and they will donate it for the purpose of conservation. This is not a conservation easement. It is not a listed transaction. It is not a risky decision here. There are other ways by which you can have land and be part of partnerships that have land and will dedicate those properties to not be developed. And those development rights are typically 5 times the purchase price. So it could bring you down to a net effective tax bracket of 20%, federal and state combined. And you can do this to offset 30% of your taxable income. And then there are some more sophisticated charitable strategies where we can deduct up to 60% of your taxable income. We can use things such as private family foundations under certain circumstances, and charitable LLCs by which you create an entity where you're using leverage within your entity, and you can offset the taxation on 60% of your adjusted gross income, which for most of you guys is your W-2 income and or profit from your entrepreneurial endeavors. And we could potentially eliminate or defer 100% of your capital gains income with these sophisticated structures. Now, these last 2 bullet points here, some of these are going to be involving trademarked, patented procedures with tax attorneys. They are expensive procedures that should cost anywhere from $60,000 to $100,000 for some of our clients operating on a certain level. We can certainly justify this if we're going to create millions and tens of millions or hundreds of millions of dollars in tax savings. Future planning. Okay, and we talked about the bonus depreciation phase out, selling the stock. If we know that you're going to jump into a higher tax bracket eventually, or you're eventually going to have taxable rental income, consider some ways that we can take advantage of income shifting. So not only could we shift some capital gains activities into the years of lower brackets, we can also do a Roth IRA rollover. If we're going to recognize the taxation and that deferred taxes on your 401ks, why not do it when you're at your lowest bracket? And what's the optimal amount? Well, we have to evaluate how much losses are we going to get from the cost seg, where's your income going, what are your future plans, and what do you want to do with these retirement accounts? And then there's going to be new entity structure. And let's talk about this from a risk perspective as well, right? Obviously, you may have heard that the LLC will segregate your business and personal liabilities, which is fantastic. So if something happens to your business, they can't get your personal assets. But what happens if something happens to you personally? What if you are in a car accident? Or what if you have a child who's a minor and they get in an accident or do something and now you are liable? What if you have any liabilities for things outside of your business for personal reasons? Well, your assets are not going to be protected because your LLC is owned by you personally. So they can have what's called a reverse piercing of the corporate veil, and they can take the assets out of your LLC. So as a way to prevent that, you can use a trust. Put the properties in the trust and structure it, right, Groucho? So you can protect yourself. There may be some additional advanced structures that you can also reduce your taxes with an irrevocable trust and some estate planning opportunities. And then there are also ways that we can create new entities and evaluate your entity structure to identify active versus passive income, reduce self-employment taxes, and create additional moving parts here. When I say income shifting, there's also an opportunity. I don't like to leave this out. You can also shift income to areas of lower brackets, like to that of your family. If you're supporting a family member, whether it be your children or your parents, and they're in a lower bracket, you can certainly pay them and shift that income out of your bracket to that of someone in a lower bracket. So as far as next steps, there's a lot to think about regarding you personally, and what we can do or what you should be doing to reduce your taxes in 2023 and beyond. We do anticipate that we're going to need to be more resourceful with our clients as the bonus depreciation phases out. It's going to be 80% this year, then 60, then 40, then 20, and then it's expected to be eliminated. We don't know what Congress is going to say, if they're going to bring it back to a different degree, but right now, or in the past couple of years, we've been taking advantage of this golden era of 100% bonus depreciation when our president was a real estate investor. Well, as these opportunities phase out, we're going to be more resourceful, and we're going to be more strategic and more collaborative to keep our clients and protect our clients from their taxes. And we're also planning now for how can we minimize taxes in the future. So as far as next steps, if you're interested in talking about how this may apply to you, you likely have seen an application in our client portal. Let me know if you haven't seen that, and you'll complete that survey so we can assess your needs and the value we can provide to create tax savings. Additionally, we'll review that. We'll give you some feedback. We don't get a chance to work with everyone who wants to work with us, simply because we don't have capacity, and certain times we get clients that are a little bit too far outside of our scope. But I am a member of the American Institute of Certified Tax Planners. I know hundreds of accountants. I'm very close to some very successful ones. So if I can't help you guys out, I'll at least, at the very minimum, try to refer you to someone who's qualified as a resource. And so that's all I wanted to talk about today. Is, as far as things that we're thinking about right now. If you want to learn more, follow me on all social media. You just search Mark Perlberg CPA. You'll see my YouTube page, Instagram, LinkedIn, TikTok as well. I didn't list it there. You also be on my mailing list as well. We try to provide a lot of value. I got a webinar next Wednesday on long-term financial planning, and we do collaborate with clients and their financial planners to see what kind of opportunities we can create and talk about the tax implications. So lots of different topics here. And what I want to do now is this is just a brief little workshop, but in order for this to really be collaborative and me to give the most value, I want you guys to now give me some of your questions on how some of these topics or other topics you're interested in may apply to you. So, I'm going to give you a couple of minutes here to give me some questions so we can keep talking about this, and let's see what we can discuss. Okay, we got one question here. I rented an apartment for the summer last year. Can I write that off as an office expense? The answer is, you're going to get this answer from a lot of attorneys and accountants, and it depends. If you had to travel there for work, then it certainly would be treated as a deductible expense if this was a business that you owned. But if you were just there for fun, hanging out at the beach, probably not a lot of opportunities. You might have been able to carve out a home office if you had a place dedicated for your entrepreneurial endeavors. Might be some opportunities there, but there may not. I would have to know a little more about the circumstances. So we got another one here talked about earlier where me and my wife have several businesses of our own, plus 2 short-term rentals that produce $40,000 each. I think here, I'm not sure if you're asking about risk, but certainly there's a good chance that you have lots of assets here, and you want to protect your assets. You have 2 short-term rentals, and you're going to be, think about the growth and equity you're going to have here. When your risk exposure, even if it's an LLC, is equal to your equity in the property. So as you pay down that mortgage and owe less and less in principal on that mortgage, you own more and more of that house. And that house is going to increase in value, giving you additional equity. So your risk exposure increases year after year with inflation, increased property values, and mortgage pay down. Got another question here. Must you start with an LLC prior to an S Corp? What is the threshold to an S Corp? Thank you, Vishal. So here are my thoughts on this. I think that you should Now, you may disagree if you're in California because they make everything harder and you got to pay like $800 to maintain your entity. But what you should do here, I want you guys to think about with forming an S corp. If you're a new business owner, you're likely going to be uncertain on whether you need an S corp or not. We need enough profitability to justify the efforts to generate to create this S corp. Now, on a side note, no rentals go into the S corp. I can go on a whole tangent. This is for active income. You can create a C corp and elect for that C corp to be taxed as an S corp, but I would recommend not doing that because we may be able to find enough tax strategies for you that we can bring your profitability so low that you don't even pay self-employment tax. And if that's the case, then there's no reason for an S corp and save you money on filing. So let's say you started a business this year or a house living business and you bought lots of equipment and trucks and this and that. We get bonus depreciation on a lot of this stuff. At the end of all of this, we may find that your profit is only down to $20,000. We shift some expenses into that active income, drive down your self-employment tax, and now we don't even need an S corp. And then we stay as that flow through LLC, which is optimal. But let's say eventually, if now or soon you get a profit of $100,000, now we likely can justify that S corp. And when we know it's right, we can do a retroactive S corp tax election for that LLC and get the S corp tax treatment for the whole year. So that's why we really like to collaborate with our client, monitor profitability. So when we make that election, go from LLC to S corp, we're confident that the efforts to do this are going to create enough savings to justify it. And now, at what threshold does that make sense? Now, it depends on a lot of factors, and the type of service and what's the fair market value of services you perform in this. So if you're working part time, the fair market value at your reasonable comp is going to be really low. But let's say you're a dentist. The pay for a dentist is pretty high. You're going to need a lot of profit to show that your profit exceeds that reasonable comp that you pay yourself by enough of a margin to create savings. But as a rule of thumb, for typical businesses, what I like to say is I want to see between $80,000 and $100,000 of profit and expected increases in profit in the years to come. So in this instance, what we want to see here is that, we don't want to see a spike in income, or let's say you're dabbling in something. We don't want to invest into that S corp because there are additional procedures and there is additional work that you and we have to do and additional fees. We really want to make sure that we can create enough tax savings to justify it and run it properly. Also, other little tax saving opportunities with the S corp, such as what's called a pass-through entity tax election, or you can rent your personal residence to your S corp, get a double write-off. Some really cool stuff there as well. And another benefit while I'm here is the S corp will reduce your risk of an audit. The most audited activity is your active Schedule C income activities. So when you move it to the S corp, you're reducing your audit risk. Do we have any other questions here that I can answer to give you guys some additional thoughts on how you can be reducing taxes in 2023 and beyond? Okay, well, I'm going to give it about 5 to 10 more seconds. If I don't see another question here, I will end the chat. And if you want to discuss more, I encourage you to complete the survey. I will give you some feedback, and we can potentially discuss putting together a package to help you guys reduce your taxes. In addition to that, we're going to look at your prior year tax return and see if the IRS owes you any money for overpayments in taxes. Oh, got one more question here. What's the difference between office supplies and material supplies? To me, it doesn't matter. If it's a deduction, it's a deduction. Whether you put on this line item or that on your return, we don't really spend a whole lot of time deliberating. But let's say that you have a computer, a desk, et cetera, and you created a home office, but you bought this material years ago. We can assess the fair market value of your equipment and furniture that has been converted into your home office and get some additional deduction. Nice little bonus opportunity when you know what's going on in the tax code. Okay, cool. Well, anything else? I'm gonna give you guys another 5 seconds. All right. Well, thank you everyone for attending. I hope that you found this conversation valuable and have some ideas to think about for your 2022 taxes and your 2023 tax planning opportunities and how we are going to treat taxes in the future. You know where to find me. You have my email and you have access to the portal. I hope to hear from you soon. Enjoy your Friday and the rest of your week.